Hi, welcome to Benefits Now. I'm your host, Frederick Schmidt on Intellectual Radio. My guest today is Bobby Reimer, a financial advisor, and we're going to be answering some questions that I previously had received, from the previous podcast. So first, I want to say thank you for those attending and going over some of the questions from our last broadcast. I'm going to let Bobby introduce herself and what she does, and then we're going to get into the questions.
Hi, my name is Bobby Reimer. I'm a friend of Fred's, and I'm the owner and president of Financial Growth Advisors located in Oak Brook, and I'm here to answer any of your financial questions.
Great. So we're just going to kind of get into the questions and see what your advice is because, as an associate, it's important that if anybody has any, that we kind of tie everything together. So the first call that we had gotten a lot on is, it said, I had left my company and I don't know if I should withdraw my 401k. I don't know really what to do with it. So what would be your advice?
Well, if someone has a 401k at a previous company, I would say, how much do you trust your previous company? Because are they going to be working in your best interest? Do you have control over the money? How much control do you have? So if it were me, was my money, I would want to take it with me. Do the research, find out what kind of a product you have. You have to send like to like, i.e. if you have a Roth IRA, you have to switch it into a Roth IRA. If you have just a regular IRA, you want to switch it to a regular IRA, but do your homework. If you have stock accounts, you have to transfer from stock to stock. Otherwise, you'll have to sell out of your positions. And depending upon what the market's doing, you might incur a loss. So do your research, talk to a few financial advisors and see what your options are. Also, if you have stock accounts, and usually that's what 401ks are, they're mutual funds, there's costs associated with moving. So find out what those are as well. But I always like to have control over my funds. So my suggestion would be probably take it with you, but do the research.
And what is your website? So if somebody wants to get a hold of you and wants to ask further questions or bring you just some questions that you can help them with.
It's fga.life. And you can just fill in the information. And if you just go to fga.life, there's also a contact number.
Great. So let me ask you this. So here's the next question that we received. It says, when should my children start saving for their retirement?
Oh, my goodness. The day they start working, that's what I told my son. The day you start working, that's when you should start putting a little bit of money aside. You can make it 10%, you can make it 15%, but just don't think about that money. That money is earmarked for your retirement. And if you do that, there's been statistics done that if you can save from the age of 21 to your retirement age, you will definitely have $1 million. Now, again, don't touch that money, and you want to have a nice return on it at 7-8% return on it. But you can definitely amass $1 million. But the time to save is from your very first paycheck.
And is there a certain age you think that they should start with, or do you think it should be when they're working?
Well, they go to school until they're 18 unless they get further education. I would say once you're in like your first real job, like if you're doing bartending or something like that, and you feel like, hey, I'm making good money and you want to put it away, by all means. But for sure, when you have your first real job out of college. Now, it doesn't mean you have to go to college. If you go to like tool and die company, electrician, plumber, start as soon as possible. And do not say, oh, well, they're holding my 401k. I'm putting away money at work. That's a part, and they're definitely a part and separate from your money. So you always save.
So paying yourself first is when yourself.
Absolutely. Pay yourself first.
Great. The other one that I had here, it says, should people in their 80s change their Medicare supplement carrier?
Oh, gosh, that's well, you and I just had one, right? Mm-hmm. And so just to catch your clients up here and your listeners up, I had a client whose friend is 90 years of age and was paying over $300 a month on her Medicare supplement and her Part D drug card. Well, she had to take a reverse mortgage out. You can imagine her husband had passed away. Money was a little slim, and they just wanted to get the cost down. So I sell Medicare supplements. However, I'm not an expert like Frederick here is. So I had to call him and ask him because of my experience, I never want to switch anybody, like even in their 80s, because they have to be underwritten. And it's a very touchy thing. Once they have insurance, you know that they're covered. So I called Frederick and he was able to get her qualified for an LIS, which is a low income subsidy. And what were you able to save her?
What was it, like 200 or
I think it
whatever
was
it was?
more. I think it was more because we did the Part D was covered. So all her meds were covered. And then a large portion of her Medicare supplement was covered as well. And I think you're still working on her to get some of the other expensive drugs covered. So yeah, definitely go with somebody who is an expert. And I'll tell you, Frederick, he really knows his Medicare supplements. So thank you so much for helping her out. That was really a godsend. Normally, I would say in your 80s and 90s, I'm so hesitant to move somebody, but you really have to go with somebody who cares. So Frederick does do his research. So
Thank
call
you. I
Frederick.
appreciate that.
Absolutely.
Now, the other one that we see, because as people get older and their incomes are getting tighter, or maybe they're not traveling as much, the question is you're right, as far as them changing supplements, the biggest problems that they have is the underwriting. There's very few that have guaranteed underwriting, but the premiums are usually higher.
Exactly.
It's generally, wouldn't you think it's generally because it's not, I mean, the supplements can get expensive, but it's also the amount of medications that they're taking that can really start dipping into their retirement, right?
Really, it can. And they always this 90-year-old woman, do you know that they gave her a new medication? And it was something new that was out in the market. And generally, the newer medications, they're so expensive. And so, yeah, it's the medication that they try to get you on. And your body also forms an immunity to certain medications. So if you're in your 90s and you've been taking something for 70, since you were in your 70s, it might not work as well. So they do have to, on occasion, switch it up. But yeah, the medications definitely are so expensive. And depending upon the carrier, they don't always cover a large portion.
Right. So it's just like your finances. You want to be able to shop around.
Exactly.
You want to see if it's in your best interest.
Exactly. And definitely get an insurance agent like Frederick who knows about these things. And you have so many contacts in your networking that, yeah, it was really a godsend that you helped her out. She was super happy.
Awesome.
I mean, this woman was living on $900 a month, and $340, I believe.
Yeah, $340
was going towards Medicare supplement and Part D. I mean, what does that leave for food?
Yeah.
So yeah, it was you really have to find somebody good.
Right. Thank you. Yeah, and I think that's the other thing that's also important is as people are shopping around is to find out so you're not you're not taking away from the food on the table.
Oh my goodness, absolutely.
Yeah.
Absolutely.
So good. The other one is because I know there's a lot of pros and cons about, does somebody stay on a Medicare supplement? Does somebody pick up an Advantage company? I think the best way, and you let me know because this has a lot to do with their finances also, is whether or not it's in their best interest to maybe make that change. Because some people, especially the older generation, they're very much stuck on their ways of thinking, I've been with this plan for, 30 years. Or whatever since retirement.
Right. Yeah, they are loyal to their insurance companies, that is for sure. But I think more and more of the older people are going out and getting their research done. There's a lot of United Healthcare has a lot of informational classes that they set up in different park districts, and many people attend. I actually met some of my good friends there maybe 6-7 years ago, Dennis and Annette. And Dennis was paying at that time $360 with, I believe, Blue Cross Blue Shield. It had just, every year there's an increase, and he had gotten up that high, and they could do it, but they didn't want to anymore. So I dropped by and we went over all his doctors and his medicines, and we found an Advantage plan for $76. Can you imagine? Almost $300 a month saving. And that's what he's been on for the last 4 years, and he loves it.
Great.
Yeah, so it can really save. So Medicare Advantage, it's not for everybody. Again, you have to sit with the clients, make sure their doctors are covered, make sure their drugs are covered. But if it saves you $200-$300, it's well worth it. Well worth it.
Yeah, depending on the supplement that they have, also the drug, because they also are not only paying the Medicare Part B premium, then they're paying the supplement, then they're also paying the drugs, the Part
Mm-hmm.
D, then they're possibly paying a Part D deductible. And
Correct.
so by the time they do this a la carte and it's all said and done, it can start to get really expensive.
It's crazy. Absolutely.
Yeah, that's what I
Absolutely.
noticed with a lot of like you said, the people's in their folks in their 80s and 90s. That's where all of a sudden it starts to really just go through the roof,
Yes.
you know,
Yes. The
and
costs, and they feel stuck, right? They feel stuck because they don't want to go someplace where they're not covered or something happens. Here it's a known. They know what to expect, but they can't afford it. They can't afford it. So it is scary. I actually did meet another lady, lovely lady, and she was paying so much. And I think you spoke with her as well. And she didn't want to switch. She was in Arlington Heights, and she didn't want
oh
to
yeah,
switch because she was just scared of what her mother had gone through. And that's just a shame because I believe you could have saved her a couple $100 a month as well. This is a month.
hmm
So it's a lot. I mean, think about it. If somebody just gave you like $200-300 more a month and you're on retirement, a fixed income, makes a big difference. But yeah, she didn't want to switch.
right. And I noticed this also not only with the health, but I noticed with the retirement, the 401, the things like that, where people are really concerned. They're not sure how or what do we do. Are we making our best bet? My advice, and see what you think of this. I always tell people to do a comparison. Do a comparison on an annual basis or whatever it might be, and see if it really is in your best bet to change your finances, to change your health insurance, to change any of it, because it's
Exactly.
your money.
Exactly. 100% right.
Good.
100% right. And the thing that you do that I really like is you're always aware of all the government programs, like the subsidies that are out there for not only drug coverage, but for the low income subsidies and how they change every year, the dollar amounts. And you're always up on that. I really appreciate that.
Thank you. Thank you. Yeah, because what I've seen is when I work with people that have the Medicare savings, previously known as Medicaid, the biggest thing is if somebody, generally, most people that end up on that system is because of age, income, or health. And
Mm-hmm.
if they're taking expensive experimental drugs, I have one client right now, their leukemia drug, and this is horrible. She works for Advocate and she can't retire. She's 82 years old.
Oh my
And I
gosh.
was like, okay, why can't you retire? Well, she has to work at least 32 hours a week
To
in
cover.
order to cover her husband's leukemia drug, which his leukemia through the employer of her working is only, I think it's somewhere around $70-80 a month. I said, okay, well, let's look and see what it is outside of the employer.
Mm-hmm.
Because of the dosage, it's right over $14,000 a month. And so it literally
It's
is one or the
insane.
other one has to
Right.
work. I hate to say it
Understood.
until one passes away.
Understood. It's terrible.
Yeah.
It's just so criminal.
Yeah.
Yeah, they need to reform those laws and take care of our people, our elder people. It's so true. And the same happens with people that have diabetes, a lot of times. I had a younger friend who wasn't eligible for Medicare. She was in her 40s and she took the shots and couldn't afford them anymore. So we kind of brainstormed and we actually went to the developer of the medication and wrote a letter and got in contact with somebody at the factory, and they supplied her with medication for a year. But that's not an indefinite thing, but at least it helped her, Monica, for that year.
Right.
But yeah, they got to do something about these costs. They are crazy. I agree.
Yeah. It's really sad when we see that. Like I work with the one carrier, as we've shared in the past. They're the only carrier I know that has $0 insulin, regardless of the insulin,
Mm.
which is incredible. I think one of the sick things about our medication in this country, medication, if I recall, it's only made in about 5 to 7 places in the world.
Mm-hmm.
It's sold throughout the world. The great thing about that is our medications are as high as they are, 60% or higher, because of advertisement. We're the only country in the world that can advertise medication and pass that on to the consumers. That's why we have.
I wasn't aware of that.
Oh, yeah. Like, for example, I have one that takes Eliquis, which is a blood thinner. Here in this country, if you had no insurance and had to get that, it's $735. If you have insurance, it's generally around $520 a month. If you've got somebody that's on an income that's under $1,500 a month,
Yes.
and they hit what's called the catastrophic, it's part of the donut hole. Again, as you folks have questions, you're welcome to be able to contact us. We can go over that, as a colleague. The phone number here, if you want to call in, is 708-223-8953. You can call us now and we can answer any of the additional questions the best we can. And if we don't have the answers, we'll get the answers. Because as I've worked with Bobby in the past, what we want to do is we want to form, as far as colleagues, so that we're able to help inform you, because there's so much information and wrong information out there. So even if we can answer the
Changing
question,
information.
exactly,
Mhm.
exactly, and misguiding. It's
Mhm.
worse with these commercials on TV.
Yes,
Oh
they're
my
so
God.
misleading.
Yes.
They're so misleading.
Yeah. Well, what they do is the programs that they gear toward is the Medicare Advantage. They
Yes.
conveniently leave out the word advantage. So now they say Medicare is going to give you this and Medicare is going to give you that, and that's not even it.
It's
It's
not
just
true.
it's insane to say the least. The other one, another question that I had is, it recently said, I have grandchildren and want to leave them something when I pass, but I don't have much extra towards it. What can I do? What would be your advice for them?
Well, I work with some fraternals, and they have an account called a Coverdell. Now, a Coverdell only allows you to put up to $2,000 maximum per grandchild. So if they don't have a lot, they could put up to 2,000. Maybe they have 3 or 4 grandchildren, do $200 each. And if the child, when they become 18, 19, 20, whenever they decide to go to school, or even if they go to a trade school, they can withdraw the money tax free. As long as it's used for books or school, anything to do with an education, the Coverdell is tax free to the child.
Okay. And is that set up just for college? So say they get older, as they're saying here, they pass away.
Mhm.
Is that money automatically given to the child? And can that
Yes.
child can it be used for anything?
Well, it can, but as long as he utilizes it or in part for school, it's tax free. So the child, we have kids that have kept their Coverdells and they just continue to grow. They've taken a part of it to pay for their books or what have you, and they still keep it. You can keep it, but then moving forward, it's taxable, right? It's only non-taxable if you utilize it for anything related to school or an education.
Great. And what if they say, okay, we don't need this, but we want to be able to pass this on to the next generation and continue to build on that? Is that something that they can do?
No, it's not multi-generational. It's
Okay.
something, it's only written in their name. So if they decide to withdraw it or they want to give it to somebody, they'd have to withdraw it and then put it in their name.
Okay. Let me ask you, because I know I have a lot of grandparents and they may have multiple grandchildren. Very rarely do you see somebody that
Just
only
has one.
one.
Yeah.
So what I always tell them, because they're confused about how do they divide their assets, or primarily their assets to their grandchildren. What I generally tell them, and I want to see what your advice on this, because there's so many different advices or different ways to be able to do this. I say is, if they're a responsible child at a certain age, is when that money should be distributed to them. Because let's face it, if you all of a sudden give, say, a child, 10,000 or 100,000 when they turn 18 or 23, I mean, let's face it, they're going, not all of them, but a majority of them are not going to invest it wisely for their future. So what is your take on how is that? Because you don't want to exclude your grandchildren and do favoritism, but you
Mhm.
want to be able to make sure that that money that you left for them is going to help put them in a better position than you or I were in. So what are your thoughts on that?
Well, it's an interesting question because there's so many different things that you can do with money if you plan it correctly. So if I had a couple that was in their 70s or their 80s and they said, "Hey, Bobby, I have this money and I strictly want it to go to my grandchildren," I might do some type of a life policy with them, but I don't think I'd leave it in the child's name. And the reason is this: if the child decides to go to college and they want to fill out like a FAFSA form so they can get a little bit of government money, that money is going to count against them.
Right.
So any money that's in their name will count against them when they complete their FAFSA. So I might put it in the parent's name.
Mhm.
If they did a life policy, that would even be better, because then their children would get whatever money they left plus the enhanced benefit tax-free, which would be great. They'd
Right.
skip out on the tax. So, yeah. So I don't think I'd necessarily put it in the kids' names.
Right. And would you set it up so that they would have to maybe finish college, or have it set up where if they finished college, then the funds would be available to them?
The only way you could accomplish that is through a trust, where the parents would then give it. They would hold it for their children up until the age of majority, whatever age they decide that is, if it's 23, 24. So that would be done via trust.
Okay. So that would protect them a little bit more. I know that's through the trust laws, and
Right.
I'm not versed there myself, but I know I've seen where it really has helped quite a bit.
Right.
So that's the big one.
Exactly.
All right. So the next question I have that I see is, how often do I really need to see my financial advisor? This is always one that we always hear often. It says he rarely calls and I don't want to invest anymore with him.
Even if you're not going to invest anymore with your financial advisor, he should be reaching out, or she should be reaching out to you on at least twice a year. What if you have someone that passes in your family and you had them down as a beneficiary that needs to be changed? We've had it already where somebody's passed and their beneficiary is not even, we can't find them, or they've passed as well. So, yeah, you always want to keep on top of your accounts. Plus, there might be something better out there. Your account might be maturing and you didn't even know it. We have people that have 10-year accounts with other investors, with other agents. And since they're not reaching out to their client, they don't really even remember how they work. So I would say, if you still communicate with your financial advisor, talk to him twice a year, talk to her twice a year. It's important to understand how your investments work and can you do better. So definitely twice a year.
Right, because it's your money. So you want to make sure that you got to have skin in the game to make sure that you're getting the best.
Yeah, you want to be a good steward of your funds. Absolutely.
Right. Because it happens where the financial advisor passes away and all of a sudden, the company doesn't really notify them. I guess another thing is, say you haven't heard from your financial advisor in a few years, is maybe to call the company to find out, is this individual still around, just to make sure. Are they still, maybe they moved. There's so many different circumstances.
Even if you have another financial advisor that you feel comfortable with, I know at the beginning of this year, I had a client whose husband passed away. They were both my clients, but her husband passed away and she was so flustered. And I decided to go over there one day and we looked at all her different investments. Now, some of them I had written and some of them I hadn't written, but I was able to help her with all of them. All it is a phone call. They don't function so dramatically different that you're not able to understand or figure out how they function. But she was so grateful, and some of the ones now you're seeing increased rates in your MYGA accounts, your fixed accounts, like 5.5%. And she was at 1.5 on some of these accounts. Wow. And didn't know it. So, yeah, it's so important. So once we figured that out, we were able to straighten everything out and get her into some better paying accounts. But it's critical. It's critical that you keep up on it. I had one client I went to see, this was like 2 years ago, and we were just visiting. We were in the kitchen and we had finished doing an application and they brought some paperwork out and something just looked weird. And I just kept going through the paperwork, started to organize it a little bit. I found $300,000 that they didn't even remember they had. And the company that it was with hadn't sent them a bank statement in 4 or 5 years. Is that crazy?
It is. So let me ask you this. What if they had, here's a great example, and we do this all the time. Say they had passed away and say you didn't see those papers. What would have happened eventually with that $300,000?
I don't know.
I always wonder that with the insurance companies, if somebody passes away, I know if they don't have a beneficiary, it goes to the estate of, they have to go through all the legal stuff.
Right.
But what happens like this?
Well, with big banks like Chase, it's cheats back to Chase. And so then you have to go through all this rigmarole to get the money out. But with insurance companies, I can't really tell you what happens with them. But I know that one of the insurance companies did contact me on somebody, a beneficiary who had passed, and they were looking for another beneficiary to give the money to on an account that had been written by a colleague of mine. And I don't know if they found that person or not.
Wow.
So yeah, it does happen.
So what would you say of all the years that you've done this? Would you say that's the biggest surprise that you've had?
That is the biggest surprise. That is the biggest surprise. I was really shocked. I was shocked that they hadn't gotten a statement because I saw the statement from 2014 and it stopped. I didn't see any further statements. So yeah, I mean, it happens. I don't know why, but it does happen. So it's up to you. Make a good list of all your investments. And then if you feel comfortable with your advisor or you don't feel comfortable with your advisor, get another one because anybody can help you, right? Anybody can help you. But always keep up on how they're performing, how they actually work, because you forget. I mean, this is something that I do every day. So I can look at a policy and say, oh, this is what this will do. Why did you buy it? It doesn't work for you. But they forget. So it's so important to just review it every year.
And how do you feel about them having somebody other than an advisor, but somebody that can keep up with their paperwork? Because you think about when somebody passes away, they don't always know. I mean, you think about if somebody like your son had to walk into your house today in the business, it's a little different. But how many people would really know where to be able to find everybody's paperwork, or how to be able to get in contact with them?
It's true.
Because now we got the cloud and then we have the folks that keep everything. Or I love
all their paperwork.
Exactly. Love when they tuck it into a book.
Yeah.
And then all of a sudden you're helping somebody clean out some stuff and you realize you've just tossed out CDs. You've tossed out literally cash.
Mm-hmm.
It's just incredible. Do you think that there's a better way for them to be able to, or have somebody that they trust, that they know what's going on? Or to kind of mainstream, I guess, is really the question.
Yeah, I don't know. I mean, it's up to everybody individually, right? Free will. But for our clients, we have a cover sheet. So if they have more than one investment, every year they get a cover sheet on everything that we hold for them and what the values are.
Okay. And when the time comes, they have to present the death certificate. And
correct.
Whoever the beneficiary is.
Correct.
Okay.
Correct.
Okay. I know there's no straightforward with this. It's just incredible, depending on the generations and, literally stashing stuff under their mattress. That's another favorite one,
Mm-hmm.
Speaking of, I had a client one time, she wanted to do a cash up for her life insurance policy.
Okay.
And it was something like, this was back in the late 90s, and it was somewhere around, I think, $50,000 or something. She came from the Great Depression. You didn't trust banks back then. So she said, oh, I'll be right back. She brought a little baggie and there was the $50,000. And it's like, okay, no, I can't really accept that.
Right,
but it was still like weird,
Yeah.
It was just like, I shake my head. I was like so surprised with that. So, all right. So the other one we have here, got a few more. It says, would you stay in the market after retirement? And they ask, it says, I don't like it, but my husband wants to stay in. What would you say then that? Because you could give your advice, but they have to live with each other afterwards. So how do we?
Exactly. Well,
you don't want to find out you got a beneficiary situation after that either,
Right. Well, being in the market, some people feel so comfortable and they're really good at it. And as long as you watch your progress on the various holdings, I don't think there's anything wrong with keeping it. I do have a motto that whatever percentage, so let's say if you're in the market 80% and 20% of your money is fixed in your 30s, great. In your 40s, if you switch that 30-70, when you're in your 60s, I think you should probably have 50-50 if you're well-versed in how the market moves. If not, I think you should start to get into more secure, right? Because you want to know how much you have available to you at retirement.
Right.
And let's not forget, many of these people forget about capital gains, right? Reduces the amount that they actually have, the net effect, and taxes.
Yeah. Taxes is a huge one.
Yeah, I get people all the time, oh, I have $1 million, I'm all set. I'm like, no, your business partner has a portion of that money. Who's that? Well, the IRS,
Yeah.
right? Because when you retire, your IRA money is all taxable, and people forget that.
Right.
So yeah, you have to, as you get older, I think it's wiser to put a little bit more of your portfolio in a fixed, so you know what you have in
So
a
you
fixed
kind of
account.
have your hands on it at all times to know,
Well, not
well, not all the
necessarily,
time,
but that
but
it's not fluctuating, that it's not subject to market losses, right?
right, right.
So,
So yeah, because it's funny how, when we talk to people or when somebody passes away, that how many of their families don't even know what they had when they
right,
were here. They don't know how many bank accounts they have.
right.
They don't know, my favorite is I walk in and somebody shows me, or after a senior has passed away, I go in and all of a sudden they bring out 7 or 8 policies and the family's going, oh, we've got $300,000 worth of life insurance. And you have to tell them, I'm sorry, but none of these policies are valid. They
Mm-hmm.
just kept the policies to keep the policies.
Yep. Yep.
I see that all the time. The other one is, as a piece of financial advice, I tell people when somebody passes away, do not take that life insurance policy to the funeral home. You want to, that's another, I think, great piece of financial advice is that's another piece you want to be able to financially have planned out ahead of time.
Yes.
Because how
Yes.
many people do not realize, they're playing up on emotions at that point in time. If anybody's ever had to pay for a funeral or go through that, it gets crazy.
Yes, it does. It does. Absolutely.
I generally tell them as soon as somebody passes away, it sounds crazy. I always say, who has a Costco membership? Because that's where you get the casket, because it's going to be a lot cheaper. And then,
Now that's one I haven't heard.
Yes,
I didn't know.
they don't have them in this warehouse.
Okay.
But they have them where you can get that, and it's usually Sam's or Costco. You usually have.
I did not know that.
Deliver them to the funeral home.
Wow.
It's also how do you do that when somebody's not prepared? How do you drive the cost down? One of the major, on a kind of segueing a little bit here,
Mm-hmm.
the biggest one is people don't realize is when somebody passes away and now they have to do all the funeral arrangements. It's like 240 some odd pieces that they have to put together, at the last minute. And, they're no longer here to figure out what are their last wishes.
Right.
Because it's the same thing where all of a sudden that's where families start fighting. Families think they have sometimes more money than what they do, and sometimes they do, and sometimes they don't. And then it's trying to figure out, how or what does the family want?
Mm-hmm.
I love it when somebody says, oh, well, I told so-and-so.
Mm-hmm.
Doesn't work that way when you're gone, because they're not bringing you back to answer the questions anymore.
Right.
So that's what we have. So the other one, a few more we have here. It says, we got a call from a couple that had a matured 10-year account. They could now take income, but wanted to know if there was something better they could do with the money. It doesn't seem like we'll get a lot. So how could you help them with something like that?
Well, when they say it doesn't seem like we'll get a lot, it seems like they looked into getting income from that account and it wasn't what they expected. So my thought is if they have a 10-year account that's maturing, they're probably still relatively young. At which point I would say, let's see what the accumulated value is, what the account is worth. Let's see when you do want to start taking income, and let's see what ratios they're offering at various insurance companies. The payout ratio is so important. It's so critical. You can get a company that has a quasi-decent accumulation. However, their payout ratios are really crummy, like 4.5%, 5%. That is a huge, huge difference. If you can get an insurance company with a higher payout ratio, it makes all the difference in the world. We had one where they had a 10-year account, and I think they had 300. But their payout ratio, because they were so younger, was 4.5. So they were only getting under $10,000. And to live on $10,000 and you have 300,000. So we found somebody that had a way higher payout ratio. We're able to get them close to 18,000, almost double for 200,000. with the other 100,000, we were able to purchase a different account that would give them long-term care. So it depends on where you're at in your life. If you have a 10-year account and it matures, how much longer can you wait to pull income? And then what type of accounts are available to you and what are their payout ratios? So a little bit of research to do there, but I would definitely speak to somebody and get all your ducks in a row for that one. Get all your information.
And that somebody being you is what I'm thinking, because of the fact that they could come to you. What's your
Yes.
website again?
Absolutely. It's fga.life.
Great, great. And my website's below here on the podcast as well. So if you want to get a hold of us, because what we're talking about, folks, what's so important about this is how many folks people do not realize. You're welcome to call in. Again, the number 708-223-8953. It's to be able to know, are you being led down the right path? Are you covering, as you were saying, Bobby, all your ducks in a row?
Mm-hmm.
You know, you don't want to know that you're going along and 2 of your 3 ducks are dead. And then all of a sudden you don't know, what do you do now? Because as you get older, we only have so many years. And let's face it, how many times do we see people that are still working, you know, in their 70s?
Or going back to work at 80s.
Yeah.
Look at Walmart.
Yeah.
I mean, half of those greeters are like pretty old. And there used to be all the young people. Did you notice that?
Yeah.
It's quite a number of older people. I totally agree with you.
And it's really sad, because it could be, you know, they have outlived their income. You know, I think what I've also seen are those that have had, you know, the white collar jobs, they're a little bit more educated about how or what to do. And I think that's what we're really seeing now. Those that were not as educated, they were just trying to raise a family. They were just trying to keep the food on the table. And, you know, and they did well. You know, they didn't live above their means, different than today's, you know, economic classes. But then all of a sudden they get to retirement and they realize you know, how do we live on, you know, it's horrible when you see somebody that knew that they made 50 or 60,000 as a couple. They go to retire and now they're making under $1,500 a month. And it's a huge shock. So that's why I always say, folks, that you want to be able to look at your finances. You want to look at it. You want to be able to get somebody that has a very biased opinion to be able to give you the advice. Mm-hmm. We had talked about as far as advisors. What would you say that, you know, because we want to be able to have one that we can rely on. But do you think that they should be able to look at or talk? How do you feel about them looking, not shopping? That's not what I'm saying, but being able to talk to other people to make sure that they're getting the best.
Oh my gosh, 100%. You should interview different advisors and their different approaches. It's just kind of like friends almost, you know. I mean, the majority of my clients, they feel free to call me all hours, all days, Saturdays, Sundays. If there's something that's really pressing on their mind and it's their finances, I encourage them to call. Now, every Sunday I can't answer, but I do get back with them as quickly as possible. So pick somebody that you feel comfortable with. Pick somebody that you believe will do a good job for you, that gives you the information that you need, that contacts you on a regular basis, that keeps you abreast of what's going on out there as far as what's available, right? What kind of accounts you could benefit from.
Right. What's in your best interest.
Right. Exactly.
Yeah.
And you get a good feel for people. I mean, if you feel you're being sold or you don't understand something 100%, you kind of get that icky feeling. Don't go with it. Just say thank you and then talk to somebody else. You'll find that comfort level and you'll know when you have that right person. You'll know when you have the right financial advisor.
Yeah, you don't want the say, and I know they get a bad rap, but you don't want the car salesman mentality.
Right.
And you want to be able to make sure that whatever you are or whatever you have, they're able to expand upon and show you ways to be. And that's what I feel really separates a lot of us in the industry, is to be able, instead of telling people, sharing with people what their options are. And then really at the end of the day, it's up to you. But how many times, you know, it's like when you go to a doctor, you ask a doctor a question, it's going to be flat. And if you take the advice, you don't take the advice. But, you know, on this one here, if you don't take the advice or you don't start shopping around and you don't start looking at, what I mean by shopping around is making sure that you are truly diversifying and getting the best income, you know, or getting the best return is really what that is, because you only have so much time and you only have so much money.
Absolutely. I mean, look at the people I was just talking about before. That actually happened several years ago where the gentleman came to me. He had a matured account, and I can't remember the name of the company. Yes, I do. I remember, but I won't say it. But they were only going to give them $9,700 a year for 300,000. And we were able to almost double that using only 200. I mean, now think about how the quality of his life. Now, he was a great saver. He had different accounts, so he wasn't in any kind of trouble. And he could have had the other account, and he would have been just fine. But how would that make you feel if I could get you $10,000 extra a year? You wouldn't turn it down, you'd probably be very grateful. And so I just look and, how many people turn on their income without having a review done, and how many people are passing on that kind of money. So yeah, it's really, really important before you do something that you can't take back, like turn on income. You should have someone else review it if you have any question in your mind.
Right.
Be a good steward.
And a word of mouth also. Didn't mean to jump in, but yeah, a word of mouth, because a lot of times you get online, you get confused. There could be sites that, tell you that it's in their best interest. It's like a doctor. You walk into a doctor, they have all these accolades on the wall, and they have the worst bedside manners.
Mhm.
What I find is word of mouth seems to be really good. Because when my clients refer somebody to me, speaking of, I think I shared this with you once before, is where I happened to be reviewing a client's just health information. I had found out her husband had passed away. Well, he had just over $100,000 in the annuity, from his 401k. Well,
Mhm.
the bank that she and he were at, the bank president had decided that they should go ahead and she should put that in a savings account and not touch it.
Why?
It was obviously that was in the bank's best interest, for what she was earning for $100,000 and for it just to sit there and for her not to live. Well, we had finally found through our other associate, we had finally found somebody that could really help her, give her an active income so she could utilize that money and she could live. And she's really, really grateful. But it went from bad to worse.
Oh, I remember that
Yeah,
one. I
yeah.
remember.
Matter of fact, I got a call from Chris. Chris had called me and said, so and so's over at the bank, go rescue her. And I had to figure out what he was talking about. Well, the branch manager had pinned Chris. When you get a chance, ask him about this one. Had pinned Chris and had pinned the client. The client was sitting in front of the bank president. It was a smaller bank, was crying because she wouldn't let her out of her office, because she was trying to force her to cancel the contract that Chris had put together for her. And it was like, I mean, I literally I've never had to go rescue a client before.
Wow.
It was incredible. She got in my car. She was shaking. She was crying. I mean, when I took her to Burger King, I mean, they thought somebody had died. I mean, it was just incredible that this isn't too uncommon where people take advantage of people.
Was she older? Older lady?
She'll be 60. So
she was
63.
young.
No, yeah, she's 62 when this happened. So it was just real recent. But we see this. And it's also what I tell folks is wherever your money is, you don't want to give 100% trust. My opinion, if you have a child, you have somebody doing it, you want to be able to kind of follow behind them, because we hear these horror stories all the time where all of a sudden, like look at the one gentleman we were sharing from Good Times, where all of a sudden the elder abuse. What happened with that?
I don't know. I didn't completely read the entire article, but that one actor from Good Times, who's such a wonder, and he also played in Roots, they're investigating elder abuse against him. I mean,
it's sick.
It is. That we really have to watch our older people. If you have a neighbor, anybody that check on them, see if they need help. So reach out, because these people are they
very
need
vulnerable.
Us. They're very vulnerable. They need us, and they're preyed upon. It's horrible.
Yeah.
But yeah, I read that. I couldn't believe it.
Yeah, and it's not only that, but it's also looking at things such as, their credit. A lot of times they're older. They're not going to most likely need the credit. If it's there, it's great. It's theirs. They should have it. I remember years ago, I was sitting in the home. We were filling out somebody's life insurance. There was a knock on the door, and, she comes back and she's just crying. I thought somebody else died the way she was crying. And it wasn't that. They were there to repossess her car. And she was like, she didn't drive. She hasn't drove in years. Somebody had gotten her credit 3 years prior to that. They had gotten a car in her name. And so for whatever reason, when they got the car, they continued to make payments and do what? Not, well, 3 years after, they didn't make the payments. Well, the car was to be repossessed. Well, they only had that. We found out later on it was a grandchild that had taken advantage of her. And we hear this all the time where people, especially if they're invulnerable, if they're blind, if they're, there's so many there. It's horrible to think that we don't want to be paranoid, but we want to be able to make sure that if we're going to trust somebody with, say, our ATM card, that we're going to be able to truly trust them, because we see this time and time again, because the older generation, they didn't have to lock their doors. They
Right.
could have left their purse in the car. They could have, and nowadays it's just, we have to use a lot more caution. I think there's a difference between being paranoid, but I think there's also that fine line between being paranoid and also being aware of what's going on, and that being your finances. Like the one we had helped where we saved her money with the supplement. She had family members that she could truly trust. That makes a difference. Not all the I see this time and time again.
Where they're alone, yeah.
Exactly.
It's really sad.
Yeah. And where all of a sudden, the only time sometimes I see children or grandchildren is when that Social Security check is dispersed.
Oh.
And, and it's sad, and it's really trying to be, because God willing, we're going to get to that age, and we're going to hope somebody is going to step in to be able to be on our side when that time comes.
Absolutely.
That's great. That's
Absolutely.
great. So again, what's your website again, Bobby? So
it's
people can have it.
FGA.life. financialgrowthadvisors.life.
Great. And when do you think, before people start to retire, that, because a lot of people, by the time they get to 63 years old, or whatever it is that they're saying, okay, I got a couple of years. Do you think they should start looking, what do you think would be a good age for them to start looking at before, to say, okay, are we near or at the proper retirement age, so that our income is where that is? I know there's no set age or anything, but
no, I think that, like, when you're in your 40s, enjoy your 40s. When you get 45, like, start making a plan, right? People don't plan to fail. They just fail to make a plan. So when you're in your 45s, just start to put, like, earmark certain monies, right? I think, once you start working, like I said, start putting your retirement money away. But there's also other retirement. Your job hopefully is putting a 401k together for you. But when you're 45, start to put a plan, and then every 5 years review that plan, right? Whether it's life insurance to get tax-free income, whether it's just a regular annuity account that you're adding to, whether you're getting a payout from your parents on an account that you've created, whether you have real estate and you're getting rental income. Just start putting a plan together, and then every 5 years tweak it, right? Because the market changes. We're seeing that now. The stock market isn't as, let's say, beneficial as it was 10 years ago. So yeah, everything changes. So definitely have a plan in place by 45 and review that every few years.
And also, as we had talked about, how the tax bracket changes.
Oh, yes.
Drastically,
Yes.
where all of a sudden, it could be better or it could be worse, depending on what you're doing, depending if you're inheriting a home.
Right. And now in 2025, we know that the sunset provision that the previous administration had put in place, that's going to be erased. So we're going to go back to the tax rates that were in place prior to the previous administration. So your taxes are going up 100%. And then they're probably going to go up because of all the fiat money that they're printing. So yeah, taxes is a big issue. Definitely. Right. So if you're going to save, if at all possible, if you can do life policies or Roths, definitely go that way, so that when you retire, the money that you have saved is actually money that you get to keep. Because if it's taxable money, you're looking at probably 45 to 50% you're going to lose in taxes.
And that's huge.
Monstrous.
I mean, yeah. It's kind of like
500,000, between $1 million and 500,000. I'd rather have $1 million.
Yes. Like I had somebody recently talking to me about my mortgage, and they were talking about, well, why don't we refinance it? And they were talking about a little bit higher of an interest rate. And then when I looked at that interest rate, I mean, it would have gone up only about 1.25, but that 1.25 over a 30-year, it was astronomical how much that was literally just to be able to get me the little bit that they were going to get me out of my house. I mean, not out of my house, but, pull the equity out to see that it was going to be over $120,000 that it was going to
People
cost
never
me.
do the math. It always makes me laugh. Like if you purchase a $300,000 home and you put $50,000 down and you have a $250,000 mortgage and you make the payment as they designated over the 30-year period, just do the math one time. Just take your payment times 12 times 30. You will have paid for that house 2.5 times. So it's why it's so critical to make an extra payment each month. I don't care how little it is. If it's $50, $100, if you can afford it every month, do it. And in the memo section, always put down applied to principal only.
Correct. The other one that's great is what I noticed is even if a lot of them have the amortization calculator, if I'm saying that correctly.
Amortization, yeah.
And so a lot of times if you pay, say your mortgage is $1,300, you put 15, as I've seen with a few people, what you're doing is you're paying yourself advance. You're advancing yourself. The other one I also tell folks when it comes to mortgage, pay extra mortgage payments as you go along. So that gives you the cushion. The last thing you want to do is if you've lost a job or have gone through a financial hardship is now you're trying to scramble to figure out how do you make that next mortgage payment. So if you're 6 months down the road that your next payment, your next mortgage payment's due 6 months down the road, you've got that cushion there. That's going to give you that because there is no guarantee for tomorrow.
Right.
That's the biggest thing. So I want to say thank you. We're going to start wrapping up here. So I want to say thank you so much for your time and all of our years working together. I think it's been wonderful. And I think it's great that we can collaborate to be able to figure out how or what do we do. And again, your website, in case they want to get in contact you, because we want to be able to know that people have a resource or have the ability to reach out to us. My website is below. And then, Bobby, your website again is?
FGA.life. And please, any questions that you have, even if it's with a different investor, if you're not sure of how it works and you have nobody to call, please don't hesitate. I'll be more than happy to look at your accounts and explain them to you.
Right. Because a smart investor is always a wise investor because you're going to know where and what's going on.
Exactly.
Do you have anything else before we close out today?
No, I just want to thank you so much for having me on your podcast. And, I wish you all the best. And I actually have another client I'd like to discuss with you afterwards.
All right. That sounds great. I want to say thank you to Intellectual Radio. I think this is exciting. I look forward to seeing what other questions that will be coming in, over the course of the next week. And I look forward to being back here next Thursday to also address any questions or concerns.
Awesome.
So thank you. Thank you.